everyone. Welcome to our channel. We are a financial technology regulation podcast named So Talk. I'm your host, Yanyan. Nice to meet you guys. So recently, when the Trump family's meme coin was launched on the Solana blockchain, it attracted over 2 billion in trading volume in just 3 days, and even causing network congestion on Solana. This digital gold rush has not only got everyone talking about Solana, but also shows us the craziness and possibility of the Web3 era. So today we'll explore how Solana supports this trend and the technical and regulatory challenge behind it. So first, let me introduce our financial regulation expert, Mia, who has deep knowledge of crypto assets regulation. Hello, Mia.
Hello, everyone. I'm happy to join you today.
Thank you. And next, welcome to our traditional finance representative, Sarah, who focuses on financial innovation and risk management. Hello.
Thank you, Yanyan. I'm looking forward to our conversation today.
And thank you. Finally, we're excited to have cryptocurrency supporter Nero, who has deep understanding of the Solana ecosystem. Hi.
Hello, everyone. I'm trying to share Solana's story with you.
Nice to meet you guys. So before we dive into this discussion, let me briefly introduce Solana. So Solana is a high-performance blockchain known for its ability to process thousands of transactions per second at extremely low fees. Solana's most unique innovation is the proof of history mechanism, which allows it to achieve high throughput without sacrificing decentralization. And now let's start our discussion. So Web3, as you can see from the picture, is giving people ownership of their digital assets, and Solana is lending this change with NFTs. Magic Eden, Solana's main NFT marketplace, let creators mint NFTs for just $0.01 compared to $50 to $100 on Ethereum. So this helps artists like Sopunk earn millions without any traditional art background. So Nero, may I ask, how does Magic Eden showcase Web3's innovation, and what advantages does Solana bring to NFTs?
Thanks, Yanyan. Magic Eden shows how Web3 is changing digital assets. Firstly, Solana is fast and cheap, handling 65,000 transactions per second, unlike Ethereum's 50s. It's like upgrading from a single-door gallery to a massive exhibition hall, making trading smoother. Secondly, NFTs are easier to mint and sell, thanks to Solana's efficient system, like switching from an older printer to a speed-high digital one. Most importantly, creators earn more when artists made $2 million in 6 months, something hard to achieve in traditional art markets for a middleman.
Thank you very much for your explanation, Nero. So if we compare the traditional art market to an elite club, then Magic Eden is like a street art carnival. And it's such an interesting perspective. Speaking of traditional markets, and Sarah, what's the real difference between the traditional art market and the NFT market?
Oh, great question. The traditional art market is mature, backed by centuries of history and expert validations. So it's stable, but has high entry barriers. NFTs, on the other hand, are driven by new technology and rely on community consensus and market sentiment, making them more volatile but easier to access.
That's a really clear comparison. I'm curious though. So as a traditional finance representative, where would you invest your money, and could you tell us why?
It's a tough one. I would put most of my money in the traditional art market is more reliable, then allocate a small portion to NFTs to explore new opportunities. But remember, NFTs comes with serious risk, so treat carefully.
Oh, I'd like to add something here. Traditional market intermediaries charge high fees, while platforms like Magic Eden greatly lower their barrier for creators to enter the market, making art truly democratic. This is a real creative revolution.
That's a fantastic point, Nero. So this brings up an important question I'd like to ask about Mia. So from a regulatory perspective, what challenges does the NFT market's innovative model bring?
Well, the NFT market definitely presents an unpredicted challenge for regulation. I'd like to analyze this from three angles. The first is the money laundering is a huge concern. Solana's anonymity and a low fee make it perfect for a criminal to split illegal funds across wallet. And second is the intellectual property and the compliance issue, especially with dynamic NFTs that can adjust their content or attributes based on the external data sources, potentially causing the dispute about the right of original NFT creators. And finally, is the cross-chain transaction and the governance issue. Different blockchains have different legal scopes, and compliance requirements causing the legal status of the NFTs to change during the cross-chain transaction.
Oh, yeah. You mentioned important intellectual property protection issues, but every NFT transaction is recorded on the Solana blockchain. It's unchangeable, which greatly reduces fake problems in the traditional art market. Also, smart contracts can enhance royalty management. So, do you think we should promote resolutions based on blockchain rather than relying on traditional legal proceedings? How can we balance those two approaches?
Well, that's an excellent question, Nero. Indeed, although the NFT smart contract and on-chain record can provide that the wallet address holders a specific NFT, but this doesn't directly equal owning the intellectual property right or commercial usage right for that NFT. The NFT often sees piracy or unauthorized minting, where some users upload existing artwork, photos, game assets, to NFT market without the original creator's permission and sell them as NFTs.
I think we are missing something important here. I'll also add that the NFT market has serious risk of manipulation. For example, some people fake trading activity to inflate prices or hype up a project only to sell off quickly and leave others with losses. There are even cases where creators abandon projects entirely, leaving investors with nothing. The traditional art market is heavily regulated, but the NFT space still lacks clear rules, making it harder to protect your money. Plus, NFTs rely on blockchain technology, which can have security issues, leading to stolen assets. It's a risky space, so you really need to be careful.
Those are all valid concerns, Sarah. You're so right. So looking at the biggest picture, how are different countries addressing these challenges, Mia?
Well, it varies quite significantly across regions. The different countries are trying different approaches. The US is strengthening the security regulation. The EU is developing the comprehensive framework, and China has strict market access rules.
Whoa, thank you. And for all these insights. The NFT market shows the potential of digital assets, while DeFi represents how these assets can be put to work in the financial system without intermediaries. So this naturally brings us to the thriving DeFi ecosystem on Solana, especially the governance challenges faced by the Solana lending protocol. So let's move to our next topic. So DeFi is another key application of Web3, and Solana has become a hotspot for these financial services. Solana, as you can see, is a major lending protocol on Solana, faced an interesting governance crisis. Solana is a lending protocol on Solana that allows users to deposit assets for loans or provide funds to earn interest. So, as you can see, in June 2022, as the crypto market plumped, an account holding a large amount of SOL tokens faced liquidation risk, potentially causing Solana serious losses for Solana. The Solana team urgently proposed temporarily taking over this account, leading intense debate between decentralized governance and emergency intervention. So Nero, can you tell us how do DeFi lending protocols change the traditional lending, and what does this crisis reveal about Web3 governance challenges?
That's a complex but fascinating question. DeFi lending is like a self-service loan machine. No banks, no paperwork, just collateral. Traditional loans are like job interviews, while DeFi loans are automatic contracts based on purely on the assets. The Solana crisis revealed a big dilemma. Should DeFi stay fully decentralized or step in when risks threaten the system? A whale account with $20 million in Solana faced liquidation risks, which could have crashed the market and clogged Solana's network. Solana tried to take control to prevent chaos, but this went against DeFi's core principle of decentralization. This highlights Web3's biggest challenge, balancing automation with human intervention when things go wrong.
That's such a vivid way to explain it. An interesting analogy. So when that whale account faced a liquidation risk, it was like a super large customer potentially going bankrupt, and the bank had to decide whether to intervene as an exception.
Exactly, and it reminds me of something we've been seeing before, the 2008 financial crisis. Traditional finance and DeFi have very different risk sources, but the outcome can be equally devastating. In traditional finance, risks come from people not repaying loans and systems being over-leveraged. In 2008, banks used complex tools to lend too much, and when liquidity dried up, the system collapsed. DeFi has similar risk, but the triggers are different. In DeFi, risks are more about code bugs, oracle attacks, or flash loans being used to manipulate markets. Plus, traditional finance had bailouts in 2008, but DeFi has no central bank to save the day. The bottom line, both systems can collapse from leverage and liquidity issues, but DeFi's decentralization makes it even more fragile and harder to fix when things go wrong.
Wow, that's a really eye-opening comparison. And Sarah, from a traditional financial risk management perspective, how do you view systemic risk in DeFi? And can traditional financial risk control experiences be applied to DeFi?
Well, it's complicated. DeFi's systemic risk are both similar to and different from traditional finance. The biggest challenge is decentralized itself. DeFi runs on smart contracts and algorithms with no central bank or regulator to step in during a crisis. When markets swing widely, automatic liquidations can trigger a domino effect, pushing prices down further and causing panic. Plus, if too many users try to withdraw at once, smart contracts might not keep up, making things worse. We can borrow some ideas from traditional finance like dynamic collateral ratio or liquidation buffer pools to absorb shocks. DeFi insurance like National Mutual can also help protect against hacks and smart contract failures. But these tools need to work in a decentralized way, which is tough without a central safety net. We need smart compromise. Regulate the application layer but keep the protocol layer decentralized. Use DAOs, insurance, and audits to boost transparency and reliance. And create centralized emergency liquidity pools managed by DAOs to stop single liquidations from crashing the market. It's a balancing act to avoid disaster.
That's a thoughtful analysis. So let's now consider the regulation angle. Mia, I'd like to ask, what new requirements do this DeFi governance crisis place on regulatory frameworks?
Well, from my perspective, mainly in four aspects. The first is the government's transparency and accountability. The regulatory framework need to clarify who has the right to make the decision in emergency and how to ensure the decision transparency. The second is smart contract auditing and compliance. The regulatory agents are exploring how to audit and clarify code to ensure it meets financial stability requirements. The third is market risk and liquidity management, need new regulatory thinking. The regulatory agents need to rethink how to set appropriate risk buffer requirement for DeFi without stifling the innovation. And finally, is the cross-border compliance and regulatory collaboration. Global regulatory agents need to strengthen the collaboration, establishing the unified regulatory standards and information share mechanism.
That's quite comprehensive. Though I'm curious, how do regulatory agencies from different countries view the financial stability challenges brought by DeFi?
While the approach varies significantly by regions, the US takes a tougher approach using the security law like KYC and AML rules, and licensing to bring DeFi under the traditional finance. The EU relies on the MiC Act to enhance the transparency and on-chain identity verification, with potential for bolder regulation in the future. China takes a strict stance, banning the crypto transaction and promoting the digital yuan like ECNY as the alternative. Overall, the regulation is moving toward the compliance, transparency, and risk control, with future consensus like on KYC and cross-chain oversight to balance the innovation and stability.
Oh, I have a question, Mia. Is that possible excessive regulation will kill DeFi's innovative potential?
Well, that's a fair concern, Nero. Regulation and innovation aren't opposing force, but are complementary ones. Appropriate regulation can provide a clear legal framework, reduce the uncertainty, and attract more compliance capital and institutional investors to the DeFi space, driving the technology innovation and the mature applicant development. Past risk events in the DeFi space, like the 2022 Terra ecosystem collapse and the 2023 cross-chain bridge attack, show that the environment lacking regulation easily leads to the system risk. Actually, the hinder DeFi long-term development. Appropriate regulation can enhance the users' trust, reduce the market volatility, and make the industry more robust.
Oh, I see your point. But couldn't we improve DeFi safety through the self-regulatory organizations plus insurance funds rather than relying on traditional regulation?
Well, that's an interesting alternative approach. Solana's ecosystem can enhance the DeFi safety through the DAOs and the insurance fund, but self-regulation alone may not fully address risks like cross-chain exploit. A hybrid approach combining DAOs, insurance, and clear compliance standards can provide a stronger protection while maintaining the decentralization.
Thank you, guys. This has been such a rich discussion. Our discussion has covered multiple aspects of the Solana ecosystem, from NFTs to DeFi. So let's summarize today's conversation and look to the future. One last fun question. If you were to predict an unexpected application scenario for Solana and Web3 5 years from now, what would it be? Nero, you can go first.
I think in 5 years, we'll see Solana powered decentralized wellness network become a reality. By combining Helium's decentralized wellness network with Solana's high throughput and low latency, we can achieve larger scale wellness network development, supporting millions of IoT devices connections. Imagine business and individuals worldwide developing wellness hotspots and earning wearables through the Solana blockchain, building a truly decentralized, high-performance, low-cost IoT infrastructure.
Oh, that's a fascinating vision. Turning to more immediate concern, Sarah, how should traditional financial institutions respond to the changes brought by Web3?
From my perspective, traditional financial institutions should embrace blockchain to boost efficiency. Banks and payment companies can use smart contracts and automatic clearing to cut cross-border payment costs. Think JP Morgan Coin or Visa's blockchain solutions. They should also explore DAOs and NFT markets, offering services like custody, trading, and risk control for digital assets. With their risk management expertise and regulatory know how they can become key players in the Web3 financial world.
Thank you for that practical advice. And finally, Mia, how should future regulatory frameworks evolve to better adapt to this emerging field?
Well, I believe as a high-performance public chain, the future regulatory framework need to be evolved toward on-chain regulation, smart contract compliance, and cross-chain regulation and institution-grade DeFi to adapt the Web3 ecosystem. Since Solana used the cross-chain bridge like the wormhole, future regulation need to ensure the transparent and compliant fund flow across chains. Regulatory sandbox, global cooperation, and institution define politics can help balance the regulation and innovation, supporting Solana's sustainable growth.
What incredible insights from all of you today. So thank you to our three guests for your brilliant insights. The development of Web3 and the Solana ecosystem is still in its early stages, and both technological innovation and regulatory frameworks will continue to evolve. We'll keep following developments in this field. Thank you for listening to our podcast today, and we'll see you next time. Bye-bye.